Did Dodd-Frank work? Financial regulation history explained. Imagine a world where the financial system nearly collapses and taxpayers are left holding the bag. That was the reality before the year 2010. The Dodd-Frank Wall Street Reform and Consumer Protection Act was created to prevent that from happening again. It was a response to the chaos of the 2000 financial crisis. The goal was to make the system safer, more transparent, and fairer for consumers. The law introduced many new rules and agencies. It created the Financial Stability Oversight Council to watch for risks that could threaten the entire financial system. It also gave the Federal Reserve more power to oversee large banks and non-bank financial firms. The Consumer Financial Protection Bureau was set up to protect everyday people from unfair financial practices. One of the most talked about parts of the law was the Volcker Rule. This rule stopped banks from risky trading activities and limited their investments in hedge funds. Dodd-Frank also set up a process called orderly liquidation. This meant regulators could wind down failing financial firms without using taxpayer money. Large banks were required to prepare living wills to plan for possible failures. Banks had to hold more reserves and pass annual stress tests to show they could survive economic shocks. The law also increased transparency in derivatives markets and imposed new rules on credit rating agencies, hedge funds, and private equity firms. Supporters say these changes made the financial system safer. Since the law was passed, no big bank failures have led to taxpayer bailouts. The Consumer Financial Protection Bureau has recovered billions of dollars for consumers through enforcement actions. It also helped prevent risky practices that could cause another crisis. But some critics argue that Dodd-Frank is too complicated and costly. They say it can restrict credit and slow economic growth. Over the years, some parts of the law have been rolled back or changed. This shows ongoing debates about how much regulation is enough. Looking at financial history, Dodd-Frank marked a major shift. It moved the United States toward more oversight after years of lighter regulation. It aimed to learn from past mistakes and balance market freedom with safeguards. While it is not perfect, it has changed how the government oversees banks and protects consumers. It set new standards for financial stability and accountability.